Good day everyone and welcome to the premium video newsletter for Tuesday, July 16th, 2013. Starting with the fundamentals, we had two reports released this morning. The first one was consumer confidence. The U.S. consumer prices rose a seasonally adjusted 0.5% in June to mark the biggest increase since February, as the cost of gasoline, housing, medical care, clothing, and food all rose. The expectations on the street were a rise of 0.4%, and the market did not react much to this number at all. The second report came out was the industrial production, which regained some momentum in June after weak numbers for both April and May. Overall, industrial production rose 0.3%, following no change in May and a 0.3% decline in April. Expectations were a modest 0.2% advance. The market did not react at all to this number whatsoever. Most of the influence on the market is coming from earnings this week. Both Coca-Cola and Charles Schwab came out with earnings that were below expectations, and the market began gradually descending after a fairly flat morning session. Another interesting earnings development came from Goldman Sachs. While the company doubled its growth and had terrific earnings this season, there's a lot of talk about changes in industry regulations that can have a major impact on this company as well as other investment banking stocks. Notice technically, Goldman is not as close to testing the highs as other stocks such as the indexes and tech stocks. This is a bearish technical sign for the stock and something that could have a big effect on other banking stocks that rely on investment banking for the majority of their income. Notice today Goldman sold off more than the majority of the market with strong volatility to the downside, even in light of the fact that the earnings were very strong. The other reason why volume and volatility is low this morning is because the market is waiting for Chairman Ben Bernanke to testify before the House Financial Services Committee in Washington tomorrow. So I'm anticipating some volatility tomorrow unless nothing comes from the Feds, and we're going to see that tomorrow in the morning. Looking at the technicals, we have some interesting developments that need to be addressed. First, the stock market was looking very bullish yesterday, but we had several clues that the rally was not for real. First, volume was very low, and the range yesterday between the high and the low was very narrow as well. This is not common for a breakout day. Second, I always look at the transports to see how the market is doing because the transports seem to lead the market, both on the way up and down a good percentage of the time. One ETF I rely on for my transport study is ticker symbol IYT, which tracks the Dow Jones Transport Companies. If you look at yesterday's high, this ETF was still fairly far away from the highs. This alerted me to the fact that transports are still a fair distance away from breaking the May 22 high price. As a matter of fact, to give you a good example of how accurate this ETF is, take a look at the day it made the high. The S&P peaked on May 22nd, while this ETF peaked 2 days earlier on May 20th. I always look at this ETF near important breakout levels to see if the ETF is following or leading the major indexes. Lastly, there have been very few setups to the upside during the last few weeks. Typically, when markets are making new highs, I get very large number of buy setups and very few sell setups. The setup numbers have been fairly even last few sessions. I screen my setups for the best ones, but I use the raw numbers to determine market bias, and I can't say that the last few days I've seen any bias to the upside, which is extremely unusual during a new breakout in the indexes. The U.S. dollar continued breaking down this morning. I've been calling for a weakness in this market for a few weeks now, and it's finally beginning to show. If we break the current price level of 82.40, we should be heading down to the 81.50 level, and if we can't find support, we will eventually hit the 80-50 level. With the uncertainty in the U.S., especially so close to September, when the Feds are supposed to begin cutting the stimuli program, I doubt the dollar will have the confidence to move substantially higher for the foreseeable future. Gold continues to show unusual strength around these levels, and although I was confident about the 1300 number, I do believe based on the strong technicals that gold should move higher, possibly even to the 1350 level before declining once again. I do believe this market is a great long-term shorting opportunity, but I want to make sure you get the highest price when you're selling gold. If you trade stocks, consider GLD ETF, which tracks the gold market almost tick for tick. Another interesting development is in the Swiss franc, which appears to be leading the British pound right now. I'm looking at the franc for possible opportunities to spread it against the pound. So pay attention to the Swiss franc and notice the breakout that occurred earlier today. This may continue for the next week or so, especially if the US dollar continues its weakness. There's a new setup for tomorrow in the retail sector. The stock symbol is DKS and the stock name is Dick's Sporting Goods Stores. The stock is not too correlated to any of our holdings, and I recommend you place a sell stop at the 50.35 level, and if filled, place a buy stop at the 51.50 level. That's it for today, and I will update you tomorrow morning. Expect some volatility because volume is low, and news tomorrow can really cause some movement, especially after Bernanke speaks. Have a great night, everyone.